Here's something almost nobody tells you until it's too late. The day you die, the bank freezes your account. Not after the funeral, not next week. The moment the bank is told you've passed, any account in your name alone is locked. And here's the part that catches families completely off guard. The money is still sitting right there, sometimes tens of thousands of dollars of it, and your husband or your wife cannot touch a single cent. Not for the funeral, not for the mortgage payment that's due. It's frozen, sometimes for weeks, until the estate is sorted out. There is one free thing you can do in a few minutes that stops this from ever happening to the person you love most. And one part of it is even more powerful than most people realize. Let's go through it. Picture a couple, married over 40 years. The everyday account, the one the pension lands in and the bills come out of, has always been in his name alone. Not from secrecy, just an old account from before they retired that never got changed. He passes away suddenly. In the middle of the worst week of her life, she goes to pay for the funeral and discovers the account is frozen. The pre-authorized payments have stopped, so the electricity and the council rates are bouncing too. The bank isn't being cruel, it has a legal duty to protect that money until the right person is confirmed to handle the estate. But that duty doesn't make it any less devastating to be standing at the counter unable to pay for a coffin with money that's sitting right there. Here's why the bank does this, because understanding it is the first step to getting around it. When you die, everything in your sole name becomes part of your estate, and the law says nobody can simply help themselves to it, not even a spouse. So the moment the bank is notified, it freezes the sole account so that nothing moves until an executor is properly confirmed. From the bank's side, that's responsible. From the family's side, it can be devastating. Both of those things are true at once. Now for the first piece of good news, and it's a big one. A joint account, one held by two people together, is generally not frozen when one of you dies. In Australia, this is called the principle of survivorship, and it's built into how joint accounts work. Ownership passes automatically and completely to the surviving holder, and this overrides anything a will might say to the contrary. Probate isn't required to access it. The surviving partner simply presents the death certificate to the bank, and the account continues in their name. So one of the simplest, most powerful protections available to a married couple is making sure the everyday account, the one the pension lands in and the bills come out of, is a joint account, not a sole one. If that couple's everyday account had been joint, she would have walked into the bank that same week, and the money would simply have been hers. No freeze, no scrambling to borrow from family, no added grief stacked on top of grief. One honest caution here, because I'd rather tell you the whole truth than a tidy half of it. A joint account between spouses, for the money you both rely on day to day, is straightforward. A joint account between a parent and an adult child, added purely for convenience, is a different animal. The law doesn't automatically treat that as a gift to the child. It can get pulled back into the estate, and it can accidentally create real conflict with other children who weren't added. Joint with a spouse for shared everyday money, genuinely simple. Joint with an adult child as a shortcut, get proper advice first. Now let's talk about where most of a retiree's actual savings live, because this is where the single most valuable move in this entire video comes in, your superannuation. On a super account, you're allowed to make a death benefit nomination, telling your fund exactly who should receive your balance when you die. When that nomination is in place and current, the money can go directly to the person you named without sitting inside the frozen, probate-bound estate at all. It can reach your spouse or your family in weeks rather than months, completely separate from whatever's happening with your bank accounts and your will. There's an even better version of this for retirees who've already started drawing an income stream from their super. If you have an account-based pension, you can nominate your spouse as a reversionary beneficiary. When that's set up, the pension doesn't stop and restart from scratch. It simply continues automatically in your spouse's name, without a gap and without your spouse having to make a new claim from a standing start. Compare that to a couple where no reversionary nomination was ever set up. The surviving spouse doesn't just lose their partner, they also lose the income stream overnight and have to start an entirely new claims process with the fund from scratch at exactly the moment they have the least capacity to deal with paperwork. A reversionary nomination is the difference between that income simply continuing without a gap and it stopping cold while the fund works out what happens next. It's the smoothest possible handover of that income, and it costs nothing but the time to set it up properly with your fund. Now, here is the trap inside the fix, and I need you to really hear this, because it can undo everything if you get it wrong. A binding death benefit nomination on your super is only good while it's current, and in most funds, it automatically expires after 3 years unless you renew it. If it lapses and you don't renew it, it typically reverts to being treated as a non-binding preference instead of a binding instruction, which means your fund's trustee gets the final say on where the money goes, rather than your original wishes being followed automatically. And here's the part that really matters. A valid binding nomination generally overrides your will. If your super still names an ex-partner from a marriage that ended decades ago, and your will leaves everything to your current spouse, in a lot of cases the super can still go to the ex-partner, because the account-level nomination wins over the will. Making a will and feeling organised isn't enough on its own. You have to actually check what's written on the nomination itself, and confirm it's still who you'd choose today, not who you'd have chosen years ago. Picture someone who married young, divorced in his 40s, and remarried a woman he spent the next 30 years with. He did everything he thought he was supposed to do. He made a will, and it left everything to his second wife. He felt organised, responsible, done. But decades earlier, when he first opened his super account, he'd named his first wife as the nominated beneficiary, and in 30 years, through the divorce and the remarriage, he never once went back and updated it. If that nomination had lapsed and reverted to non-binding, the fund's trustee would at least have discretion to look at the real family situation. But if it had stayed current as a binding nomination naming the first wife, his super could still have gone to a marriage that ended decades earlier, while the will he was so proud of organising covered everything except the one account that mattered most. That's not a rare freak scenario. It's exactly the kind of thing a simple 3-year check would have caught before it became a fight nobody could undo after the funeral. So here's the honest shape of protecting the people you love. Move your everyday shared account to joint, not sole. Check whether a death benefit nomination is sitting on your super, and if it is, confirm it's still current and still names the right person. If you're drawing an account-based pension, look into a reversionary nomination for your spouse. And put a reminder in your calendar to check that nomination every 3 years, because letting it lapse quietly undoes all of this. 2 honest notes before you go. First, the exact rules can vary by bank, by super fund, and by your specific account type, so confirm the details directly with your own bank and fund, rather than assuming this applies exactly the same way everywhere. Second, this is general information, not personal or legal advice. How you should structure your own accounts and nominations depends on your family situation. So this is exactly the kind of thing worth confirming with your super fund, your bank, or a licensed advisor. If this is something you've never checked, tell me in the comments. It helps me know what to cover next. Take care, and I'll see you in the next one.